All right, let's dive right into this explainer and play a little investment detective with SPX Technologies. If you follow the industrial sector at all, you've definitely seen the ticker symbol SPXC flashing across your screen, usually surrounded by a sea of blindingly green numbers. But today, we're looking past that flashy exterior. We want to see how this high-performance vehicle actually runs, what kind of fuel it's burning, and honestly, the biggest question of all, whether the sticker price actually matches the horsepower under the hood. We're going to break down the raw financial data and separate the market hype from the mathematical reality.
Okay, we just have to start with this shocking hook. I mean, look at this number, 1,210.84%. That is the massive 10-year return SPXX has delivered to its investors. To put that into perspective, you're talking about multiplying your initial investment by more than 12 times over a decade. It's the kind of sustained, incredible speed that makes value investors and growth chasers alike just stop and stare. It proves there is a serious engine driving this growth.
So naturally, that brings us to the exact question you're probably asking yourself, and it's the one every smart investor absolutely must answer before jumping into a stock moving this fast. Is it too late? It is totally human nature to look at a 1,200% past return and feel a massive case of FOMO. But you know the drill, past performance does not guarantee future results. So the core of our analysis today is answering this specific question by looking at the data right now, today, to see if the fundamentals actually justify hopping on board or if that train has already left the station.
Part 1, a decade of massive returns. Let's break down the timeline. We know the 10-year picture is spectacular, but we really need to zoom in and see what the stock has been doing lately to see if it's stalling out or accelerating. Look closely at how these numbers shift as the time frame gets shorter. Over a 5-year period, the compound annual growth returns were a very respectable 29.68%. But as we narrow our focus to the 3-year window, boom, that jumps to 48.57%. And if we look at just the trailing 12 months, the return is an absolutely blistering 75.50%. So the company's growth returns are actually speeding up in the near term. The momentum is literally compounding.
And this momentum wasn't just some lucky one-off fluke either. You know how sometimes a stock has one crazy year that skews all the averages? Well, here we're looking at a sustained streak of massive yearly returns. Over 53% in 2023, 44% in 2024, and over 37% in 2025. Stacking consecutive years of returns well over 30% means a company is consistently beating market expectations and delivering tangible, growing financial results year in and year out.
All right, moving to part 2, inside the profitability engine. Let's finally pop the hood. So a stock price doesn't just go up in a vacuum, at least definitely not for a decade straight. It has to be driven by underlying business success. To see what's powering this, we lean on the CAGR, or compound annual growth rate. Basically, think of this as the true smoothed-out growth rate of the company's engine. It strips out the wild volatility of individual boom or bust months and gives us the most accurate picture of how fast the core business is truly expanding. Keep that smoothed-out baseline in mind, because these metrics show a staggeringly powerful engine. The real standout? That jaw-dropping 966.22% 3-year net income growth rate. I mean, wow. That is an explosive metric, and it goes a really long way in explaining why the stock has been racing higher. But even if we smooth it out over 5 years, net income is growing at over 20%. And looking at earnings per share, we see a 3-year CAGR of over 65% and a 5-year of 23.5%. The underlying business isn't just growing. Its profitability is expanding rapidly. Let's ground those percentages in actual dollars for a second. Looking at the trailing 12 months, the company generated a massive $2.265 billion in revenue. But hey, as we know, revenue is just vanity if you can't keep it, right? Well, SPX Technologies effectively converted that top-line sales number into $244 million of pure net income profit. They are raking in massive amounts of cash and incredibly efficiently pulling a huge chunk of it straight down to the bottom line. Section 3, Balance Sheet Health Check. Now that we know the engine is generating hundreds of millions in pure profit, let's check the chassis, because a fast car is dangerous if the brakes don't work. In financial terms, that means checking the balance sheet to make sure they aren't taking on reckless, dangerous risk to fuel this growth. Thankfully, SPX operates with a super low debt-to-equity ratio of just 0.22. Actually, the source data notes this is nearly 50% lower than their historical average, meaning they're running with a very light debt load. Contrast that with a highly robust current ratio of 2.48. That means for every single dollar of short-term liabilities the company owes, they've got $2.48 in short-term assets sitting there ready to pay it. they can easily cover their obligations. Furthermore, their quick ratio, which if you remember is a much stricter test of liquidity because it strips out inventory, sits at a very healthy 1.82. And notably, that is up over 41% compared to their 5-year average. They're literally getting more liquid, not less. Throw in a return on invested capital of 9.46% and a return on equity of 10.91%, and it proves management really knows how to steer the ship. They're taking the money they have and generating solid, reliable returns on it, all without leveraging the company to the hilt.
Okay, moving to part 4, the valuation reality check.
So, we've firmly established that SPX Technologies is a highly profitable, rapidly growing company with a rock-solid balance sheet. But a great company can still be a terrible investment if you pay too much for it. It's time to check the sticker price. Look at the PE ratio, the price to earnings. It sits at 44.40. Now yes, that is objectively a high multiple, but it's actually down almost 18% compared to its 5-year average. However, look at the rest of the board. The price-to-sales ratio is 4.95, which is a massive 45% higher than the 5-year average. And the EV-to-EBITDA ratio is nearly 24, up over 15% from historical norms. Aside from earnings, almost every other metric screams that you are paying a hefty premium today compared to what historically paid for this exact same quality.
And honestly, this is where the price tag really starts to sting. The price-to-free cash flow ratio is currently sitting at 46.72. Cash flow is the ultimate truth teller in business, and right now, investors are paying nearly $47 for every single dollar of free cash flow the company generates. The real kicker? That multiple is roughly 67% higher than the average investor paid over the last 5 years. The market has absolutely 100% priced in the company's recent phenomenal success. Which brings us to our final section, intrinsic value versus market price.
To really answer the ultimate question of value, we have to compare the market's current price, which we know is trading at a high premium, to the actual calculated intrinsic value of the business based on its cash flows. Enter the margin of safety. Smart investors demand this buffer. It protects you against errors in calculation, unexpected business hiccups, or just general market downturns. You always want to buy $1 for 80 cents, not $1 for $1.20, right?
Well, here is where the math gets a little dangerous. The calculated margin of safety for SPX Technologies, based on our source data, is negative 38.43%. Yep, negative. This means you are getting absolutely zero buffer. In fact, if you buy the stock today, you are paying a massive premium over the estimated intrinsic value of the underlying business. There is no room for error here, folks. The company must continue to perform flawlessly just to justify this current valuation.
Let's put that negative margin of safety into real hard dollars to make it crystal clear. By juxtaposing the market's current price against the fundamental fair value, the gap is pretty striking. The last closed price for the stock was $222.45, but the calculated fair value price, based on discounted cash flows, is only $160.69. That is a massive difference. The data clearly shows that perfection is already priced into the stock. You are paying for years of future growth right now, entirely upfront.
And that leaves us with this final, provocative thought. The numbers we've dug into today prove SPX Technologies has a powerful profitability engine, incredible historical returns, and a remarkably safe balance sheet. But the valuation metrics and that deeply negative margin of safety tell us it's currently priced at an absolute premium. So here's the question. Is a phenomenal company still a smart investment if you have to overpay to own it? Consider the data we've explored today, weigh that fundamental business strength against the highly demanding sticker price, and decide for yourself before you put your own money on the line. Thanks for joining me on this explainer, and keep asking the hard questions.